Hello and welcome to Ask for a Trend. I'm Josh Lipton. The market's experiencing a sharp sell-off yesterday, and while a recent poll showed a majority of people are anxious about the economy, investors are remaining confident in the broader market. For more, let's welcome in now Caleb Silver, editor-in-chief of Investopedia. Caleb, always great to see you, especially on set. So you have great line of sight into retail investors. The folks at Investopedia, Caleb, how are they feeling right now? It sounded like the bottom line was, okay, a bit nervous, who can blame them, but not selling.
Yeah, I think they're caught between high anxiety, but they don't want to stop believing, especially in their favorite stocks. So they've been freaked out by a lot of the volatility in the stock market, the steep drops. A lot of them, I would say 30%, have been trying to catch the falling knives here, trying to dollar cost average in or buy dips on their favorite stocks. Others are just paralyzed kind of by we just don't know how this is going to play out, but something seems amiss. And one thing that we watch really closely here is not only are 44% extremely worried, which is a high mark for us, but folks who are trusting the capital markets less and less. And one big question we ask them is, has your deterioration in your faith in the capital markets been impacted by this administration and by this tariff policy that they can't depend on right now? 55% say they trust this administration less when it comes to preserving the integrity of the capital markets, and I think that's pretty serious.
I thought it was interesting to see, typically when people get risk averse, they might move into the bond market, try and get some capital appreciation, but maybe tied to that concern about the faith in the capital markets, what we're seeing is that investors basically eschewing anything other than cash under the mattress.
Yeah, so cash, you see 1 in 10 go into cash here, and when you see what they're buying with their cash, some of it is just straight cash, some of it is high yield savings accounts, and CDs are trying to get a good rate on that. Others are trying to chase individual stocks. We see a little bit of ETF buying. We ask them this question always: what would you do with an extra $10,000 if you had it to invest? And it's still individual stocks because there's that promiscuity, and they have this long love affair with the biggest stocks in the market, right? The herd loves the big stocks, but the next selection under that, they were talking about money markets, or we're talking about CDs. So that shows you that there's some risky people here that are willing to go out on the deep end. Others just are uncertain right now and want to see what happens before they make any big moves with their portfolios.
We have strategists come on, Caleb, won't surprise you, and some folks have they're looking overseas, especially Europe. You've heard folks pound the table on that. Do you see that among the folks in Investopedia, or no, they want to stay U.S.-centric?
They're homers, and they're so faithful to their favorite stocks. We always ask them every 2 months, what are you holding? What's your biggest positions? It looks just like the S&P 500, especially at the top, or the NASDAQ 100, especially at the top, and that rarely changes. It takes a lot to move one of their favorite holdings out of it. We also ask them, what stocks would you buy today and hold for 10 years? Guess what? It looks very similar. So this sort of faith they have that what had brought them here, these incredible returns over the last 5 to 10 years, will do that over the next 5 to 10 years. They still hold on to that despite the fact that a lot of these stocks have been leveled. And maybe they think, hey, I'm getting it at a discount. I want a dollar cost average in. We're going back to growth. But I don't think they've fully captured the fact that many of these companies just aren't going to grow like that anymore. And the circumstances, the economic dynamics are really not set up for that at the moment.
I was shocked to see in this report basically no mention of gold. I mean, it's the best asset class, best performing asset class in the market over the course of the year, and a great performer over the course of the last couple years, and yet basically no interest. What's it going to take for the retail investor to get interested in gold?
I don't know. Maybe if there was an ETF that offered a way to own it by proxy. No, I just think these are stock jockeys. I don't mean that they're trading all the time, but they're so faithful to stocks in the stock market. They've been on Investopedia for years. They read our newsletters every single day. So that's kind of the language that they know. You don't see a lot of private capital. You don't see a lot of private market stuff. Very little crypto, I thought, in this round as well. Sometimes that gets a little high if you see price correlation there. When the price is up, more interest, more people trying to buy it. What you see is people either sticking with stocks or sticking their hands in their pockets because they don't want to make a move right now. The uncertainty is just too great, and maybe they've been burned over the past few weeks. But when you look at research from a Vandatrack or you look at Bank of America flows, retail investors have been pouring money in the market now over the past several weeks, and it's only burned them in doing so. So you got to wonder at what point they stop trying to catch the falling knife.
Final question. There's been more concern about the U.S. economy looking ahead. The R word's been popping up. How worried are folks in Investopedia about recession?
40% or more say they think that we're going to be in one, or if we're not going into one right now, 50% say that's probably what's going to happen over the next 3 to 6 months. Now, they may be just hearing a growing drumbeat from Jamie Dimon and Larry Fink and more economists and a lot of CEOs talking about it, and just gets in their mind. And that's the psychological impact of just hearing it over and over again. Are we in? Well, I don't know. Everybody says we're in one. You don't know it until you are, or it's in the rearview mirror. So a lot of people think that that's what's going to happen. We'll see if that translates into spending. The gap between how people feel and what people actually do is very fascinating to watch right now when you see this fear at these extreme highs.
Caleb, always great to see you, always, especially on set. Thanks for coming in.
My pleasure.
And a big thanks, of course, to Bob Elliott for hanging with me today. And before we let you go, Bob, just so people understand, you actively manage ETFs. You got a new one, ticker HFGM. It just launched this week. Give me the quick summary on this.
Yeah,
one.
I've been in the hedge fund business for 20 years, and my goal was to bring hedge fund strategies to the everyday investor. You know, strategies that most people have typically been locked out of. And what we do with HFGM is we take all the best 500 macro managers, we understand how they're positioned in real time, and then we put that into an ETF. So if you want to navigate through this volatility and essentially hire the best and the brightest to figure out what's coming ahead.
Your point being a fund like this would tend to do well in the kind of volatile environment we find ourselves in?
This is a perfect time for macro strategies, both because the volatility creates a lot of opportunities, and because these managers can be defensive in the way that long-only managers are kind of stuck when you've got a market trend that's moving down.
Bob, thank you, sir. Appreciate your help today.
Yeah, thanks for having me.
That was terrific. All right, stick around. Much more Ask for a Trend still to come. U.S. stocks close mixed, ending another down week on Wall Street. Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Josh.
All right, Josh, we're going to play off your theme today. I want to look at a trend that we're seeing right now in soft data, and sort of the question is if that's going to be moving the hard data later on in terms of the economy. So what we're looking at here is two regional surveys from regional banks of the Federal Reserve. So this is the Philadelphia Fed Manufacturing Survey. Look at that move down, Josh. So this is April's survey. This is including the tariffs, also some of it including Trump's repeal of some of those tariffs as well. So the surveys were done throughout the first 2 weeks of April. But this move lower that you see in current manufacturing activity from the Philadelphia Fed, the fourth largest month-over-month move on record. The only other times you've seen big moves like that were 2022, 2008, and it's at one of its lowest levels in 2 years, one of its lowest levels that we've seen overall. So this is survey respondents telling the Philadelphia Fed that the outlook for manufacturing right now and what they're seeing in actual activity is contracting. I want to move over to Empire Manufacturing. So this one's expectations. This is from the Federal Reserve of New York. One of the lowest readings of expectations that this survey has ever seen, going back 20 years. Of course, the key two things weighing on these surveys, tariffs, right? And overall policy uncertainty. But right now that really seems to be shaking up the manufacturing sector, and that could potentially be a concern moving forward for what it means.
So I'm an investor.
Yeah.
I'm listening to all this right now. What's my takeaway? What do I make of all these surveys, Josh?
I mean, the surveys at some point just become a recession concern, quite frankly, right? So you look at surveys like this, they often lead what ends up being an economic downturn. So if you look at, this is a good chart for us here because I can point out where recessions have been, right? Your big downturn here in 2022, go back to the great financial crisis, you saw a big downturn right before that recession. So the concern would be if businesses are feeling worse about the outlook overall, does that eventually lead to slower business investment, slower spending, and then if companies and businesses aren't operating as well, would they lay workers off? If they lay workers off, that's trouble for everyone in the economy, right? So overall, right now, these are sort of the yellow, we'll call them yellow light, yellow flag warning signs, but Chair Powell talked a bit about this yesterday and said the concern would be when we see it in the data. I think the looming question is, will it come in the data, right? You see this big move down in 2022. Remember, we never actually had a recession in 2022. So sometimes you see concerns in the soft data and the surveys, doesn't always mean we're headed for an economic downturn, but it can be, as I said, definitely a sign of caution.
Yellow flag. All right, bullet point number 2.
So this was an interesting one, Josh. So I was taking a look at the market action today, and you have the three major indexes we always talk about, right? You have your NASDAQ up or down slightly on the day, but really not down far. S&P 500 up a little bit on the day. And then you flip over to the Dow. What happened? Dow's down 1.3%. Well, so what happened with the Dow is point weighted. So companies that are larger in actual points, how much the stock costs, weigh down the index more. So what we're looking at here is the 5 largest components of the Dow. United Healthcare had terrible earnings this morning. The stock dropped 22%. That weighs on the Dow. And so it's interesting just to take a look at this and see, look at United Health, a 9% weighting in the Dow Jones Industrial Average. So if that stock sells off, which I'll get back to our screen and show you, it fell 22%, it makes a very big difference, even though there was a lot of other companies in the Dow that were actually up on the day.
Yeah, and a great example is like Apple,
Right.
which I think has the biggest market cap of the Dow components. I think it's like roughly $3 trillion, but the weighting on the Dow is low single digits, 3%, I think.
Right, and it's the opposite of sort of how the S&P 500 works, right? So
Right.
the S&P 500 is market cap weighted. So if I flip this over to market cap, you'll see these large companies that we always talk about, the trillion-dollar companies, Apple, Nvidia, Amazon, Microsoft. Those are the ones that make big moves in the S&P 500. But in terms of the Dow, sometimes these smaller companies that wouldn't necessarily move the benchmark index, the S&P 500, can really weigh on the Dow, and it gives you sort of a weird little intricacy of what's going on in the market, but it led to a down day for the Dow today.
And our colleague Inez Ferre has a great write-up on this very topic. All right, thank you, Josh. Appreciate it. Stick around. Much more Ask for a Trend still to come. We do have President Trump speaking about tariffs. Let's get to that.
Then they'll come back and say, well, we think this is too high and we'll negotiate. Or they're going to say something else. They're going to say, well, let's see what happens. But they always have a right not to do it. So they can say, well, we don't want it, so we're not going to shop there. We're not going to shop in the store of America. We have something that nobody else has, and that's the American consumer. And I had the most successful 4-year period in the history of this country, and I think we're going to blow it away this time. But there is a little bit of a transition, and we're going to have that little transition, and it's not much of a transition. If you look right now, we're getting 25% on cars, right? We're getting 25% on steel. We're getting 25% on aluminum. We're going to have some other things that we're going to be adding in the not too distant future because we want them to be made here. The medicines, the drugs, pharmaceuticals are going to be done, and computer chips, et cetera, et cetera. And because of that, we have the biggest computer companies in the world coming in from Taiwan and other places, and they're building in Arizona and lots of other places. We're number one in AI by far. We're leading China by a lot, by tremendous amounts. We're going to supply electricity at levels never supplied before. They're going to build their own electric. We're going to let them become a utility, essentially. And it's going to be amazing for the country. They're going to build their own electric plants. We have to double up our electricity to remain number one in AI. We're going to have to double up our electricity take our whole country. We're going to have to double up our electricity. Think of that. And probably even triple it up. And we're going to let them build their own electric plants with their plant that they're building for the AI or whatever they're doing. Never been done before. We're going to get them quick approvals. It's going to be very clean, going to be very nice. And we're going to get them very fast approvals. And people are investing in this country like they've never invested before. Thank you very much, everybody.
Thank you, Press. Thank you, Press. Thank you. We're headed out. Thanks, guys. We're right here.
All right, that was President Trump speaking about tariffs, which we will keep an eye on. Meanwhile, big banks posting solid first quarter earnings with credit quality holding up against the backdrop of economic uncertainty. Our next guest says consumers are showing resilience despite the market volatility. Joining me now is Silvio Tavares, CEO and President of VantageScore. Silvio, great to see you.
Great to be here, Josh.
So as investors, we're always looking for lines of sight. How's the American consumer holding up? Based on the credit data you have, what are you seeing?
Well, we have the most comprehensive data set at VantageScore, over 200 million consumers. And what we saw through the end of March is that actually the consumer is credit healthy. We measure credit health by the VantageScore credit score. A perfect VantageScore is 850, a very low is 300, and it came out at 702 through the end of March. So a very healthy credit score.
What do you chalk that up to, Silvio?
Well, it was a surprise. I got to tell you, Josh, we were expecting consumers to have deteriorating credit quality. In fact, the opposite was true. If you look at auto loans, credit cards, personal loans, mortgages, across every single one of those credit products, credit delinquencies actually declined compared to February. So consumers are doing everything they can to really get their personal balance sheet in order. They are credit healthy and they want to maintain that credit health because, of course, they're concerned about what happens next.
So they're credit healthy, Silvio. I guess the big question is, do you expect them to remain credit healthy? And what are the variables that would depend on?
Yeah, so one of the most important things for credit health is employment, and consumers are still overwhelmingly well employed. We're at historic highs in terms of overall employment. But also consumers are keeping an eye on their personal balance sheets. They're looking to make sure that they're not overextended on their credit products. We actually saw credit utilization for credit cards decline on a month-over-month basis. So consumers actually trying to lower those credit balances. And what I attribute this to is consumers really trying to focus on making sure that they are credit healthy, because there's a lot more uncertainty and risk ahead, and they want to be ready for that.
We talk about this, the consumer, Sylvia. We often talk about like it's one consumer, but of course there's high income, middle, low. Are you seeing any differences there that are worth calling out?
Absolutely. Traditionally, in a weakening or decelerating economy, it's the lower income consumers that are most vulnerable. One of the trends that is counterintuitive that we've seen over the last several years is if you look at the high income consumer, those making over $150,000 a year, so roughly twice the median income, those consumers have actually been having a very significant increase in delinquencies. If you look from January 1st to 2023 to March 31st, what you see is that credit delinquencies have increased by 103% for the high income consumer. So that's a cause for concern. That's something that we are very much focusing on as we look to the balance of this year.
Silvio, always great to see you, especially when you come here and see us on set. Thank you, sir.
Thanks for having me, Josh.
All right, time now for what to watch next week on the earnings front. We got Tesla reporting first quarter earnings after the markets close on Tuesday. Elon Musk company setting the tone for Magnificent Seven earnings this season. Yahoo Finance will have special coverage of all things Tesla on Tuesday, with coverage starting at 4 p.m. Eastern. Taking a look at Boeing, the airline posting first quarter results on Wednesday morning. Analysts expecting Boeing's losses to turn a corner, driven by rising deliveries. And another Magnificent Seven name reporting next week, that would be Google parent Alphabet, announcing results for the first quarter on Thursday. Investors are listening for any updates on its ad segment. That's after a judge ruled that Google is monopolizing the online advertising business. That is a wrap on today's Ask for a Trend. Have a great night.